Ryan from our economics group. As I say, this is the first of our oil webinars. This is a little bit experimental, both in terms of the format and the technology, so please do bear with us if we do experience any glitches. On your screen, you should be able to see ourselves in the video, as well as the presentation which accompanies what we're going to discuss. And you will also have a chat area which you'll be able to put questions into. We'll take questions at the end. And just for information, you should be aware that chat is visible to everybody that's on the call. Also, the whole thing will be recorded and that will be circulated later, so you'll be able to look at that again if you wish. Excellent. Well, before we get into the detail of oil markets themselves, obviously oil demand is very strongly driven by global economic activity. So, Ryan, could you tell us a little bit about your views of the main drivers for economic activity over the next couple of years and the risks that both on the upside and the downside?
Sure. Good morning, all. First, it's probably just characterising the start of 2016. Now, over the first quarter, we saw significant volatility across various asset markets as investors became worried about the global growth backdrop. To our minds, those concerns are slightly overblown. Global GDP growth in 2015 was recorded at 3.1%. We actually suspect that global growth will marginally strengthen again this year. We're actually forecasting global growth around 3.3% before that strengthens further into 2017, where we're forecasting growth of 3.7%. Now, the question would be, what's driving that growth? A couple of points I'd make on that. Firstly, we see the continued recovery in the advanced economies providing support for the global growth backdrop. In particular, it looks as though the Eurozone recovery is continuing, albeit at a relatively subdued pace. Within the Eurozone, household consumption is growing and investment is starting to firm as well. And if anything, we're looking at a slightly more optimistic outlook for the Eurozone than some of our other peers. One of the other big components of the advanced market economy is the growth in the United States. Now, admittedly, Q1 GDP figures which were released yesterday were slightly on the softer side and certainly a slowdown from Q4. We'd point to a number of reasons for the possible reasons for that. Firstly, Q1 historically is a relatively soft quarter for US growth. Secondly, seasonal adjustments with the early Easter seems to be an issue this year. And I suppose in relation to the natural resources industry, and in particular shale gas in the US, there was a slump in mining capital expenditure in the first quarter, which actually took 0.6% of US GDP. But we suspect that going forward, the underlying picture for the US is still relatively robust. So advanced economy economic growth should be one pillar of our outlook for global growth. The other one is what's going on in emerging markets. Now, China is obviously the big economy that a lot of people talk about. There's a lot of commentary regarding potential hard landing in China, given rebalancing which the Chinese authorities are undergoing. Now, we have a slightly more sanguine view of China than many people. We suspect that you'll see Chinese growth this year of around 6.5%. Now, that's within the target range set by the government of between 6.5% and 7%. Now, we'd make a couple of points on China. Firstly, a lot of the various views on China are driven by the view that the industrial sector in China is slowing. Now, the Chinese economy is rebalancing towards a more, let's say, advanced market model whereby consumption or household consumption predominantly makes up the vast majority of the mixture of growth. For example, if you took the average of the G7 economies, consumption represents between 60 and 70% of GDP. In China, that's just at 40% currently. with investment making up the larger proportion. So what's happening is the economy is rebalancing towards that consumption, which arguably is naturally going to lead to a slowing in those industrial indicators.
And similarly, in the commodity space, while we've seen falls in line with what you're saying about industrial production, we've seen falls in base metal demand. It's important, I think, to distinguish that from oil demand, where energy demand has remained relatively robust, and actually what you've been talking about, the rebalancing of the economy, has tended to lead to increased demand for energy in the Middle East as people travel about more.
Yes, I certainly agree with that. If you consider that China has now a growing middle class, the demand for automobiles is increasing, and therefore the demand for, as you say, fuel and for petrol is likely to increase as we go forward, as the Chinese economy maintains growth of around, as I say, around 6.5% going forward. And one point I would make is, I say, a lot of people focus on the slowing in the industrial indicators. Actually, services now represent 50% of the Chinese economy, and services grew by 7.6% in Q1, which should help to relay something that at least the Chinese economy overall is still growing at a fairly robust pace. I suppose just one other point just to touch on in terms of the emerging markets, in terms of our overall global growth outlook. We suspect you're likely to see a slight recovery in the emerging markets as we look forward. For one, India still looks to remain a fairly sizable growth driver. They should see growth of around 7% this year, but also several of the major emerging market economies which have been under pressure over the last couple of years look to be reaching the bottom in terms of their recession, particularly countries such as Russia, and they should start to see growth returning over the second half of this year and looking forward.
And indeed, we're seeing growing oil demand in Asia generally, and India in particular. So that mirrors that.
Yes. You asked about risks to the global outlook. Now, I've outlined kind of a relatively sanguine view of the global growth backdrop. What we would point out that arguably risks are balanced to the downside in terms of the global growth outlook. Predominantly, we would mention a couple as being high up the list on that front. For one, if we see renewed market volatility again at some point this year, and the reason I say that could potentially be a downside for growth is that when market volatility tends to rise, it tends to tighten financial conditions for both corporates and for households, and that can have a negative impact on the economy.
Very much what we saw at the start of the year.
Certainly. In addition to that, the low inflation outlook is still one risk that we would point to. Inflation is very slowly rising in a number of economies, but certainly in places like the Eurozone, it remains very low, and there is the risk that you get a deflation mindset starting to filter through, and that in itself can then have implications for demand and capital expenditure and things like that. So that's a risk. And in addition, China is still, although we have a fairly, I'd say optimistic view, but we expect Chinese growth this year to remain relatively stable. One risk would be that the rebalancing of the Chinese economy takes longer than expected, is not implemented as well as the government plans, and actually Chinese growth slows more than expected. So certainly that's not our central case. As I said, we can still expect Chinese growth of around 6.5% this year.
Excellent. Okay. Excellent. Thank you very much for that, Ryan. Thank you very much. Well, now we'll turn to the oil market itself, and we'll start to work through the presentation that you have in front of you. So just looking at the trends we've seen in Brent so far this year, of course well, coming from last year, the market declined very sharply. But so far this year, after reaching a low at around $27 per barrel, Brent has rallied quite sharply, moving up and down inside this trend channel here on the chart. In doing so, it has smashed through a number of moving averages and continues to display considerable upward momentum. I should say that all of the data in this presentation was snapped on Wednesday evening, so it's now already out of date because we of course seen Brent over $48 per barrel this morning on the June contract, which is going to expire today, but nevertheless the July contract, which is also just over $48 per barrel as well. At least it was when I came up. So the momentum for the time being does look to be intact. While we may see short-term pullbacks, I think there's every possibility that it can continue higher from here. We may see $50 per barrel, maybe $55 per barrel in the course of the next month. It's quite interesting actually to compare the behavior of Brent this year and last year. So the blue line at the top is Brent in 2015, and the grey line down here is Brent this year. And although they are separated by about $15 per barrel, you can very clearly see that both years started with a very heavy fall into the mid-40s in the case of 2015, $27 per barrel in the case of this year, and that was followed by a very sharp rally. Now, we will see what happens in the rest of the year. I'd be a bit skeptical that 2016 would follow 2015 in the sense of producing even lower levels than we have already this year. But nevertheless, if that trend is repeated, we might expect to see markets coming down again later in the year. Looking at what's actually what's been driving the markets recently, again, there are very good comparisons between 2015 and 2016. So the chart that you have in front of you now, the blue line at the top gives you this is data from the US futures exchanges, and the blue line at the top shows the long positions that speculative players have in the futures market. So these are people who are betting that oil markets are going to go up. The black line at the bottom gives short positions. So these are people who are betting that the oil markets are going to go down. And then the grey line is the balance between the two. And what you see very clearly, both this year and at the start of last year, is a strong build-up in short futures positions. So very, very heavy short selling right at the start of the year, which forced the market down to the lows that we saw again in January this year, $27 per barrel. But we then that then progressed, and as time moved on, we saw increases in long positions, and again in February this year we had record long positions and record short positions, and it was just a case of who was going to throw the towel in first. It happened to be the short positions, and as those people who were short tried to cover their positions, they had to buy oil, and that led to a very explosive rally. And really, what we've been seeing over the last couple of months, you can try and put it down to the OPEC, non-OPEC meeting, or a number of other things, but the reality is that it's been about momentum, and investors have just been buying into that. And of course, not all of those investors are even human. There are lots of algo trading going on as well. Anyway, let's have a look at what's going in the fundamentals, because sooner or later, any technical trends will break. It's just a question of when and how high it goes in the meantime. And the fundamentals do act as a restoring force. This chart here indicates the state of oil supply and demand over the last few years. The red line at the top indicates demand. And what you can see is that since 2012, demand has increased relatively steadily. And we're now consuming about 97 million barrels of oil per day globally. It sounds like a big number. Sometimes it's helpful, though, to put this into some kind of context. And perhaps to do that, one way of looking at it is to say that the Thames through London has a net flow rate of roughly 30 million barrels per day. So global crude oil consumption is like 3 River Thames. So if you think about it in those terms, that perhaps puts into more tangible context just how much oil we consume globally. Anyway, the bars here indicate demand, and what you can see is that early in the 2012, 2013, the market was relatively balanced. But then, of course, as we know, getting into 2014 and 15, supply started to increase beyond demand. And these dark blue parts at the top of these bars indicate the US shale production, and you can see that these bars are increasing and help to explain why that oversupply occurred. Now, in the past, one might have expected OPEC to come in and reduce their production to counteract that, but in fact, they actually, as we know, increased production, and so thereby contributing to the oversupply in the market. However, things are starting to change, and in the International Energy Agency's latest projection, they estimate the market would come into a balance, come into a relatively balanced state in the second half of this year, with only 200,000 barrels per day of overproduction, and that's down from about 2 million barrels per day of overproduction that we've seen at the peak. And this is explained partly by a decline in US production and other high-cost production, and also the fact that although Iran has been able to increase their production significantly, probably by 1 million barrels per day since the sanctions were lifted, other OPEC countries have actually have been or had to cut back production. So most of it, particularly in Nigeria, for example. So it does appear that we're moving towards a more balanced state in the market. And you can see that more clearly here on this chart. There's been an incredible amount of speculation in the press over the last couple of months about OPEC and Russia predominantly forming some kind of agreement. And to be honest, this has never looked particularly likely to bear fruits. There are just too many antagonisms between some of the key players. So between Russia and Saudi Arabia, there's a lack of trust, partly because they've formed agreements about joint caps in the past, and Russia hasn't stuck to those. That's even more problematic now because so much of the Russian production is in private hands, or independent companies. And with the ruble being as cheap as it still is, Russian production is actually profitable, and there's no economic reason for Russian producers, independent Russian producers, to cut back or even cap. On top of that, of course, that there is the fact that the Russians have sided with Assad in Syria and tend to be on friendly terms with Iran, all of which is problematic for Saudi Arabia. Because its relations with Iran, as we all know, are rather poor, to say the least, and in fact they're fighting a proxy war in Yemen and essentially are competing for regional dominance. And the competition over oil customers is another manifestation of that, essentially. And even between Russia and Iran, one of the dangers of Russia's strategy of aligning itself with international pariah states is that if they do sort of turn over a new leaf, as it were, that they drift away rather rapidly, and that seems to be what's starting to happen in Iran with the sanctions having been lifted. So the consequence of this is that it wasn't possible to reach even a completely meaningless agreement in Doha, and so I think we can be very sceptical about the possibility of anything meaningful coming out of the latest stories that there might be another meeting in May. We do, of course, have the OPEC meeting in June, and the expectation would be that that's unlikely to come up with anything tangible, but you never know. There's always a possibility that OPEC may suddenly take, and particularly Saudi Arabia may take the view that they've done enough so far as US shale production is concerned and might reintroduce the cap, and that would be a pretty significant thing for the market. In the meantime, we still have plenty of overproduction in the markets. This all has to go somewhere. That goes into inventories. This chart in front of you now shows in this blue area the range of US crude inventories in each month over the period from 2009 to 2015. And the black line indicates the average over that period. And you can see from this that the pattern tends to be seasonal. The inventories tend to reduce over the summer, and this is in response to high demand from the so-called US driving season, and indeed that this is reflected globally, people flying on holiday and so forth. Current inventories, though, as we know, are well ahead of these historic maximum levels. So we still have an awful lot of inventory. This has become a little bit less of an issue than it perhaps would have been in the past, though, because OPEC's spare capacity is much less than it was in the past. So actually sustaining very high levels of inventory is not necessarily such a problem as it once was. But the big question really will be over the summer, and we're getting close to that now, of course, is whether the US demand and global demand over the summer will be sufficient to make a meaningful dent in inventories. Last summer, the demand really didn't live up to quite what the market was hoping for, and that was probably one of the things that helped to break the trend, the upward trend that we saw in oil markets in the first part of last year. Perhaps we will have the same thing happening this year. Looking further ahead, though, this chart is research done by Barclays on investment in oil production. And what we can see is for the first time since 1986, that we've had two consecutive years of a fall in investment in oil production. And this prompted the executive director of the International Energy Agency to say that this could lead to serious problems down the line in terms of supply and being able to meet demand. So this hasn't really come home to roost yet, and may not in the remainder of this year. But it's certainly storing up problems potentially for the future, and it does create a significant potential upside risk for oil prices further down the line. That brings me on to the shape of the forward curve. So we tend to look, when we're talking about oil prices, very much at the Brent front contract, and not so much about the rest of the forward curve. But really, from a hedging point of view, it's actually the forward curve that we should really be caring about. What this chart here shows us is a snapshot of the forward curves at various times in the past. You can see down at the bottom the forward curves at various lows. So we have the low at the start of the year, also the low of the financial crisis, and the current curve here, which is close to, at least at the front end, is close to where the curve was in January 2015. Obviously, all of these are much lower than the average over since 2008, and much lower than the peak since 2008. But what is very interesting, however, is that although the curve has moved up generally a lot since the start of the year, and the front contract price is now back to where it was at the start of last year, the forward curve is incredibly flat, and actually very unusually flat given how low the market is. And the thing that explains this, I think, is that we've seen a lot of producers selling down the back end of the curve. And the producers, because of what happened in January have had a kind of near-death experience in a lot of cases, and in fact an actual death experience in some cases. And so they have been pretty active now that the market has rallied a bit. They've been pretty active in trying to lock in longer dated prices to secure their businesses into the future. And this has really helped to keep the back end of the curve down whilst the front end has been rallying. And that's great for consumers, but there also lies a danger in that, and that is that if the producers start to feel that the market is going to continue rallying, then there's no need for them to continue selling down the back end, and suddenly that selling pressure will disappear. And from the point of view of consumers, every barrel they want to buy down the back end of the curve needs to have a seller. And if those sellers start to leave the market or ease off on their selling of oil, then we would expect the curve to start steepening. Curve shape is even more pronounced if you look at it as a percentage of the front contract. You can see just how low how flat the curve is at the moment compared to the previous lows. And this is the financial crisis up here. So we've been talking quite a lot about crude oil. This chart here talks about the other the distillates that actually come out of oil. So crude oil goes into a refinery, and a range of things come out of it. These things trade, some of them at a premium to oil prices, and some at a discount, the so-called crack spread. So we can see that gasoline, which is this seasonal curve here, tends to trade at quite a significant premium to Brent. The middle distillates are also generally at a premium, although not as strong as gasoline. Naphtha is a bit of a discount, and then fuel oil, which really is a byproduct in the mix, is a significant discount. Overall, you can take a weighted average of these, and that gives you the refinery margin here, and this is essentially the profit margin for the refiner. Now refinery margins continue to be reasonably good, but this is driven very much by the strength of gasoline. And because refineries are running in order to produce gasoline, they're also producing middle distillates, and the middle distillates are not in quite such strong demand. And so but if you're going to produce gasoline, you get more middle distillates anyway. So this is the strength. Ironically, perhaps the strength in gasoline has actually, in some ways, contributed to exacerbating the oversupply of middle distillates. And herein lies another risk, because it means that if gasoline demand turns out to be perhaps less than was expected, we could potentially see the price of middle distillates increase. And by middle distillates, I'm talking about diesel, jet, and gas oil. So obviously these key transportation fuels. We can see again, looking at some historic refinery margins. This is the refinery margin curve, forward curve at the start of 2015, and so you can see that refinery margins are generally looking a lot better than they were at that time. Looking at the gas oil forward curve, because again, if you're hedging diesel or jet, this really is what matters. This is what's driving it rather than Brent. But this also this forward curve is also very flat, even though the prices have rallied significantly from where they were. And again, we see a similar pattern when we look at this as a percentage of the front contract price. So where does this leave us? And what kind of things do we need to look out for over the coming months? Well, we've had a very impressive rally in oil markets. It's been very much momentum driven. We've not seen, particularly in the last month or so, a great deal of consumer activity. So we do feel that it is being very largely driven by speculative flows. But nevertheless, the strength of momentum is still there, and I feel that in the short term, we may get some pullbacks, but I feel that the market does have the momentum to carry on a bit higher still. But the really key things to look out for now are going to be summer demand, whether we see a significant drawdown of inventories. Then there is the US shale production. Now, a lot of people have talked about US shale production as being the new balancing factor in the market, but we'll see if it actually does start to switch on again at these higher levels. And the figures to look out for there really are not the weekly rig count figures, which just tell you how many rigs there are. The best source of information is actually the US drilling report, which comes out on a monthly basis, because that tells you how much the shale fields are actually producing. Then there's a possibility of more Iranian production. The Iranians are having challenges exporting it, though, because there is still some wariness about dealing with Iran, because there are still sanctions in place, and they're very complicated, and it's people do have fears about that still. And Iran's own fleet of ships is in a relatively poor state, so that's another limiting factor in what Iran can actually do with its oil. We've got the OPEC meeting coming up in June, and who knows what will come out of that. I think based on recent form, we would not expect very much, but of course then that creates the potential risk that something surprising might come out of it, like the cap being put back in. And then finally, keep a very close eye on the long end of the curve. So are we going to see the producer selling ease off? And if that happens, we could potentially see that the market starting to rally at the back end from where it is now. So I will leave you with the disclaimer to read while we engage in the Q&A. We have had a few. There's no questions in the chat, but we have had a few questions emailed through in advance, so I shall have a look at those now. One of them is, should I hedge now or wait? This is from a consumer point of view. It's a very good question. I should say that at Investec we don't actually give advice, but the kind of considerations that you might want to think about in answering that question is there are certainly quite a few consumers out there who've done comparatively little hedging and are well behind on their hedging programs because they feel, with justification, I think, that the current rally is getting ahead of itself. However, which would tend to argue for waiting. However, what I think it's worth just going back to what I was saying about the flatness of the forward curve is that from a point of view of long-dated hedging, the curve is actually not for long-dated hedging is actually not bad levels, and there certainly are risks in the future. We never know what's going to happen, so there could be an argument for covering off at least some of the risk at these levels. However, people who are maybe pretty well done on their hedging programs and thinking about extending or just having a bit to clean up here and there, then maybe there is more of an argument to wait and see a little bit what happens over the summer. Another question I've had, which is sort of on a similar line, I suppose, really, is have we seen the bottom? My view is yes. I think that the sell-off we saw at the start of the year was as much oversold as the market is starting to look overbought now. But there was at least a very significant oversupply in the market, so one could point to that fundamental justification. But I think that if, assuming that the market does start to become more balanced, as many think it will, then it will be very hard for markets to revisit the lows we saw at the start of this year, or even go below them, unless we have some sort of global slowdown, which I think we feel is relatively unlikely, but not impossible, of course. Excellent. Well, in that case, we will finish the webinar here. Thank you very much, everybody, for attending. Trying to keep this avoid this being esoteric, but as informative as possible. However, if any of you have any questions, please feel free to email or call myself or colleagues. We're very happy to talk through anything that you've heard in this presentation that you may have further questions about or want to have explained more. Thank you very much.